Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at VALIDEA Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of VALIDEA Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of VALIDEA Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with Chris Davis, chairman and portfolio manager at Davis Advisors, a multi-billion-dollar investment firm behind the Davis funds and ETFs. We talked to Chris about the firm's rich history, including the influence of his grandfather and father, Chris's relationship with Charlie Munger, why it's important to think like an owner when investing in stocks and what metrics to look for, and how Chris thinks about acting as a steward for his investors and much more. I think you'll find this an enlightening and energetic discussion with a successful long-term investor. As always, thank you for listening. Please enjoy this discussion with Chris Davis of Davis Advisors. Chris, thank you very much for joining us today.
Oh, I'm so glad to be here. I've been looking forward to this.
This is going to be, I think, a fun and wide-ranging discussion. We're going to talk about who some of your influences, I think, are, your investment strategy, your experience and views on the market, I think discipline, compounding, and long-term investing, and all the things that I know you and your team over at Davis Funds strongly believe in. I think a good place to start, of course, is always with your background. And where I thought we could go is kind of talking a little bit about the background of your family. Both your grandfather and father were very, very successful investors. And actually, in the early 2000s, there was a book written by John Rothschild called The Davis Dynasty. And I thought we could just start there. I mean, I think kind of hearing from you some of the lessons that you learned from your grandfather and father and things that sort of sit at the heart of maybe what you believe in today and how they influenced you.
Well, that is a good place to start. I feel so lucky that I was sort of born into a family where both my father and grandfather loved what they did for a living. So investing always sounded fascinating. I always understood it to be, it's funny when somebody says, oh, you're in Wall Street, that means nothing to me. It's so bizarre to me that that's even a term because it covers, everything from, sales traders and option derivatives people to investment bankers. And I always felt like what they did and what I do is totally different, that we sort of operate instead of at this frenzied shouting sort of image that people have when they think of Wall Street. We operate really like a research institution. It's a quiet place. It's a thoughtful place. And certainly that is something that I saw in them. Charlie Munger once said that his children thought he was a book with legs. And certainly I always saw my father and my grandfather reading. It was just so much a part of what they do. And the idea that everything was relevant, that was sort of a profound early lesson. And of course, the idea that stocks are businesses and that businesses are people and ideas and assets. So from a very young age, I had this idea that the key was thinking about businesses and what makes businesses grow over time. And so that what I would call the sort of broad framework and the excitement that almost everything is relevant in one way or another. But if I was to think about two technical lessons, maybe the most important one was this idea of owner earnings. This idea that, people look at a series of numbers on a balance sheet or an income statement, and they think that that's sort of somehow the value of the business is just in those numbers without really understanding at a level how misleading those numbers can be. And because my grandfather started and really built his fortune with a single insight, which was that life insurance accounting at the time, which was 1948 or 1950, grossly misrepresented the value being created by life insurance companies. That sort of got into our DNA, this idea that you want to look at a business as if you owned the business and you thought about how much value was being created each year. And sometimes GAAP accounting reflects that value and sometimes it's massively distorted. So that idea of thinking independently, looking beyond the numbers, developing this idea of own earnings was one. And I would say that really came from my grandfather. It was practiced by my father, but that was sort of a cornerstone of his investing. And then I think what I really learned from my father was this idea that the market is constantly evolving, constantly changing. It's an ecosystem that's in flux. It's never stable. And therefore, what works for one decade is unlikely to work the next decade. So this idea of constant evolution, constant learning, constant open-mindedness, that was a real characteristic of my father. So I was thinking about it. I think those may be two sort of more specific ideas under the general one of the idea of stocks as businesses and people and ideas.
The owner earnings concept is really interesting to me because a lot of people talk about companies like Amazon and they say, for this new technology world, we need new valuation models. But what's interesting hearing you talk about that is that's really a concept you bring all the way back. So that's a concept that's existed for a really long time that allows people to understand where the value was in a company like Amazon.
Yeah, I mean, no business is worth more or less than the present value of the cash it's going to produce from here to eternity. And the question is do the financial statements represent that value in a coherent way, or do they misrepresent it? And if they misrepresent it, what is the right way to try to calculate it? So, you go back to my grandfather's day, the idea was that these life insurance companies that were growing so dramatically after World War II because the baby boom was underway and the suburbs are being built and family formation is at an all-time high. The first thing you did when you got married in 1948 was buy life insurance because you wanted your family to be secure if the bread or something happened to the bread earner and the breadwinner. But the trouble was the nature of insurance was that the salesman who sold you that life insurance policy in the first year got a commission that may be the same or even higher than the premium you would pay in the first year. And so on a cash basis, it looked like that insurance company was losing money for every policy they sold. On the other hand, they knew with some certainty that you were likely to be paying that premium, not for 1 year or 2 years, but for 20 or 30 years. And so there was a huge present value to selling that policy. But in those days, there wasn't the accounting for it was what we now call statutory accounting, but it basically meant that those companies were reporting losses. Now, the exact same is true of Amazon. You're exactly right. Amazon was willing to lose money acquiring new customers because they knew the present value of each customer was going to be so great. And I'm really just going to talk about the retail business. But because obviously AWS was its own spectacular creation. But just thinking of the retail business, Amazon was reporting loss after loss after loss on the income statement. And yet, if you looked at the actual cash dynamics, they were different. But then if you looked at the value of creation, what was the present value of getting a customer and getting their habits to form on Amazon? And if you had to offer them free shipping or great benefits through Prime and so on, it was worth it in the same way paying that big first-year commission was worth it to that life insurance company because that customer was going to generate profitable revenue for the next 20 years. Well, if you really wanted to see a cool analogy, and I did this, I don't know what year, maybe, I would guess it was around 2010. But I basically looked at Walmart versus Amazon. And what was so interesting is that it took Walmart, I want to get these numbers right. I'm doing this from memory. So I want to say that they crossed $1 billion in sales. And then 17 years later, they were at, let me see if I get this right. They increased sales. Oh, shoot. Oh, I'm so embarrassed. I can't pull up the number in my head. I've got the rough framework of it. So I'm going to give you the rough framework of it. But over a 17-year period that it took Walmart to get to $1 billion of sales, Amazon did roughly the same thing. So they grew this enormous sales machine from a standing start over a long period of time. the difference was over that 17-year period that Walmart was growing, they were reporting net profits. And yet, if you were to look at their cash flow statement, they were using cash every year. And of course, the answer is obvious. It's because to grow the sales, they had to buy land, build stores, put inventory into the stores. So growth cost them. And the way they accounted for the growth, the cost of that growth, was through capital spending. And it was very intelligent to do because they got like a 17 or 18% return on the capital they spent. So you wanted them to do it. But the point was, if you owned all of Amazon, all of Walmart for that 17 years, you had to write a check or go to the bank and borrow some money or issue some shares because the growth. Now, over that same 17 years, time shifted for for Amazon's period of growth. Amazon grew their sales aggressively, reported net losses. Yet if you looked at the cash flow, they actually generated cumulative free cash flow during that period because in essence, they were expensing the cost of that customer acquisition rather than capitalizing it. Well, that's just an accounting distortion. In both cases, the investment in new customers was totally rational because they got a huge return on that investment. So that you're exactly right. There is no different valuation metric. It's all about the present value of the cash the business is going to generate. But you have to look through at the nature of the business to understand how that, what are the distortions that the income statement or the cash flow statement or the balance sheet might lead investors to inefficiently value that business.
And I think maybe one of the challenges that some investors might have is what is the likelihood or stickiness of actually being able to monetize that customer base? I mean, we can look back now and look at Amazon. Like, I think the switching costs with Amazon right now are huge. I mean, where do people, I mean, they have all your orders, they have all the recommendations. I mean, that's where, everyone goes to order stuff for the most part. And probably for Walmart too, when they were in their massive growth, and that a lot of people obviously still shop at Walmart. So, but I think that can be all I'm trying to point out is that can be a challenge for investors to know what companies are actually going to be able to turn that investment into that long-term profit stream.
Yeah. And in fact, it's such a great point because this is going to be a strange analogy, but I used to say for every $1 David Swensen made for Yale, people are going to lose $2 imitating him. In other words, David Swensen sort of popularized and magnificently executed what I would call the alternative asset management strategy for an endowment. He basically realized that you could invest in all of these different asset classes with these high fees, but you could get diversification and higher returns. And he did great for Yale. And he was an unsung hero. And in a way, you could argue dramatically underpaid relative to the value he created. But what he did is he basically popularized this view that what endowment should do is buy a lot of high fee, leveraged asset classes because that's what works for Yale and David Swensen. And of course, the charlatans have lined up to sell that sort of illiquid, high fee stuff to all sorts of endowments, state, colleges, and others. And I think likely we'll end up having very mediocre returns or worse because they're imitating somebody that was exceptional at it. Well, similarly, I think, what Jeff sort of said was, look, I believe that I'm going to create way more than $1 of value for every $1 I'm investing now. And so just trust me, it's about get big fast. It's about create habits. And there's going to be a huge waterfall of cash down the way, but you're just going to have to trust me with it. Well, you would be crazy not to trust Jeff. I mean, my God, you look at the size of that man's brain, you look at his history at D.E. Shaw, and, that's a man that understands return on capital and is hyper rational and driven and brilliant. But it opened the door for this idea of lots of companies saying, oh yeah, we're in the customer acquisition business and we'll figure out how to monetize that customer later. And of course, then the charlatans line up and come up with business model after business model that will never be profitable, but just could raise a lot of capital and spend a lot of capital, probably culminating in the insanity of WeWork and some things like that. But they were all based on that model of, hey, the profitability of the business today doesn't matter. Look at what Jeff did. It's all about customer acquisition and building the customer, building the habits, and then we'll make all our money later. So for every dollar that Jeff created for Amazon, it wouldn't surprise me if a dollar or two was lost for all the investors jumping into models run by charlatans, or at least people that had no real plan to get to profitability, but were able to raise a lot of capital and burn a lot of capital imitating, or at least professing to imitate him.
Relating to Swenson and Bezos, you sit on the board of a number of companies, but specifically Coca-Cola and Berkshire Hathaway. And obviously those boards are made up of great executives and leadership and people with top-notch business credentials and characteristics. So what in your mind makes a really great board of directors, a solid board of directors? And if you can relate it to the ones that you've sat on, that you've experienced too, that'd be great.
All right, I will. But with your guys' indulgence, I want to rewind the clock slightly to the Amazon Walmart, because even as we were talking, I remembered the numbers, and I just wanted to
go
give
for
them
it.
to you.
Oh yeah, go ahead. Roll them out.
I just wanted to give them quickly. It took 17 years for Amazon to go from $1 billion in sales to $100 billion of sales. 17 years. It took 17 years for Walmart to go from $1 billion of sales to $70 billion. Now, if you do the CAGR on both those, they're pretty close. They're both heroic achievements. And during the 17 years that Walmart went from $1 billion to $70 billion, they were a net consumer of cash. They reported net income every single year, but they were a net consumer of cash. During the 17 years that Amazon went from $1 billion to $100 billion, they were a net generator of cash, even though they reported losses, I think, in all but one of those years. It may have even been all of those years. So it was that was the example. I was just trying to time shift, because I owned Amazon once in 2002, that era, when they were only doing $2 or so billion of sales. And then when we bought the big piece, which we bought in around 2012 or 2013, that was when they had just crossed $100 billion of sales. So anyway, and again, in both cases, what we did is we normalized the retail margin on those sales to sort of say we thought 5% was a margin that Amazon could report if they chose to. And instead, they were choosing to reinvest that margin to grow the customers. But if we were able to take a single cohort of customers, we would see the profitability growing. And as I say, in the case of Walmart, all of that expensing for growth came by having to expand the physical footprint to get new customers. And therefore, they expense that growth through the capital spending line rather than through the income. Anyway, that was, now back to your question about boards. But it bothered me so much that I was screwing up those numbers, that I had to just run that in the background just to get that sorted. So anyway, now for boards, well, I think boards are by and large, and I'm going to say in 95% of cases, overrated, in the sense that really a good board cannot make a great company, but a bad board can destroy a company. And I've seen more examples of the latter. I've seen bad boards really screw up companies. And the way they tend to screw them up is in succession, in not weighing in on significant M&A deals, in basically allowing distortions to happen, allowing, maybe viewing their job as being company boosters rather than shareholder representatives, if that makes sense. So maybe not forcing the disclosure of bad news or not demanding more accountability and so on. I think they often see themselves in relationship to the CEO rather than the shareholder. And I think so. I've seen a lot of examples of bad boards. I was going to say that if I could single out maybe the most heroic brave and outstanding board of directors that I've ever seen in my experience as an investor, it would be the directors of a company that sells a product that I don't approve of. But it's just such a singular case of representation of the shareholders, even at the expense of personal reputation, that I think it's worth calling them out. And that's the board of Philip Morris. The board of Philip Morris made a decision when there was an enormous amount of litigation hanging over the company, when the CEOs had all been hauled down to Washington, and there was this absolute, people were divesting tobacco stocks. The board of Philip Morris made a decision to split up the company, to spin out Kraft, to spin out Miller, to spin out the international business from the domestic business. And that took enormous bravery, because the notion of fraudulent conveyance accrues personal liability to the directors in that case. So they had to believe that what they were doing was legally correct, and they had to be willing to take that risk personally. And I think it was, and of course, Philip Morris has been one of the best performing stocks for the last 30 or 40 years. We owned it for some period of time and have not owned it in a long period. And that's been a mistake, frankly, in terms of shareholder return. But that act, directors' number one goal, as far as I have seen, is they often approach the job with the view of not wanting to be embarrassed. And that's a different job than trying to create or play a part in the creation of shareholder value. And I think the best directors are those that ultimately are willing to, when it is called for, take a stand, even though reputationally it may be difficult or risky for them to do so. So, I've said publicly, being involved at Berkshire it's like getting to eat your dessert first, which is not my culture. Because being involved at Berkshire when Warren, and of course before Warren and Charlie were there, you have the greatest stewards almost in the history of capitalism in terms of their mindset, their commitment to their shareholders, their sense of duty and honor, integrity. And of course, nobody in their right mind would want to attack Berkshire. Without Warren and Charlie, Berkshire has been unconventional enough that I can imagine, all sorts of people coming out of the woodwork with, shareholder proposals to unlock short-term value at the expense of long-term value. So in other words, that sort of short-term activist mindset. And it will be the job of the board to protect that culture. And, that's likely not to be such fun duty as it is sitting with, at the feet of some of the greatest, maybe one of the greatest CEOs and managers and value creators of the last century. So, I think an important duty is for directors to be able to take the slings and arrows, stay focused on the long term. And as I say, I think that's rare. And I think Philip Morris is an extraordinary example. I think Exxon has been an extraordinary example over a very long period of time. And so, the willingness to do something different than the crowd, the willingness to be unpopular, resist whatever short-term trends are there. And I like that Berkshire doesn't pay its directors in any meaningful way, because it reinforces this, that you're there out of a sense of duty. I think one of the terrible things about the way a lot of the regulations are written currently is that it makes it very difficult for money managers, investment managers, to be on the board of public companies, because you can imagine risks of conflict. But to me, it's a way greater conflict not to own stock in a company when you sit on the board. And so if we're invested in a company on behalf of our clients and myself and our family, I think, being willing to serve on the board is important. And the fact that there are hurdles that make it difficult to do so, to me, is a little bit maddening. I would wish for rules to be written somewhat differently to make it easier for that to happen.
We're listing all the characteristics of a good board member. I was like doing a little checklist in my head, and I was thinking Charlie Munger, and like I was checking every single one of them off as you described all those. And Justin and I were both big fans of Munger, and we were both really sad when he passed. And I know you had a personal relationship with him, and I know you learned a lot from him. So I was wondering if you could talk about that a little bit and like the biggest lessons you learned from Munger.
Well, Charlie changed my life. I met him. I was young enough, and I was trying to sell him a business that belonged to in my grandfather's firm, a securities lending business. And about 5 minutes into the conversation, Charlie said, "I have no interest in that business. But I'm curious how you came to think Berkshire would be a good acquirer of that business." And I was probably 26 or something. But we ended up having a 3-hour conversation, and I was just in awe. And he just built into me so many sort of powerful lessons that have shaped not just our firm or investment philosophy, but really shaped my life. So, if I was to put them into categories, if I start with the easiest one, which is around investing, I would say Charlie was the first person that I ever spoke to who really deeply understood the nature of behavioral finance and how different that was from what was peddled in business schools and, efficient market theory and modern portfolio theory. So all of the ideas of psychology factoring into investing, it was something that I had seen, in the very beginning when we were talking about, companies are people and ideas and capital and so on, the people part, I always thought about in terms of trying to assess management. But really through Charlie, you gain this idea of this lattice work of models of looking at the entire business through this lens of behavior, this lens of how people will tend to act, how will customers act, how will employees, how will managers, what's the nature of incentives, what's the nature of the competitive advantage. So many of those things come down to models that are outside of typical finance, and in many cases, models that are based on psychology of one form or another. So that was a very specific and powerful, and Charlie's talk, of any of your listeners haven't read the Psychology of Human Misjudgment, it is one of the great talks, and he gave it at what was, I believe, the first symposium on behavioral finance held up at Harvard, and you can get a reprint of it, and it's just fabulous. So that really helped. But I think beyond that, I would say the big things he taught me were and another sort of technical was just that notion of inversion, how important it is. Right outside my office, I have hung a letter that Warren wrote in 1965, I think. It might have been 66, but I think it was 65, where he outlined what he considered the major reasons that institutional money management firms underperform. And he said there were 5 reasons, and see if I can remember these as well as I remembered Amazon's cash flow. But it was, group decisions. It was the asymmetry of risk and reward. It was the desire to conform your portfolio and policies to what other large, well-regarded firms are doing. It was over-diversification and inertia. And we could go deep on any one of those 5. But I blew up that section of the letter, framed it, and hung it in the center of our research department because I said, if we just avoid some of this, we should have an above average result. Well, that's a Charlie way of thinking. So instead of thinking about what do you do to outperform, think about what do you do to underperform and try to avoid it. Try to structure your firm so you don't have group decisions and you don't have that asymmetry and you don't have over diversification and you fight inertia and you fight the tendency to conform your portfolios to what others are doing. So inversion was a big part. And then I think personally, Charlie, the 3 words that come to mind one was habits, that you can alter and improve yourself through just creating better and better habits. So that would be sort of 1. 2 was, one way to do that is be very focused on role models. I actually have a portrait of my grandfather in my office. I have a bust of Charlie. Those are the people, he said, having these physical reminders. He had one of Ben Franklin in his office. Having these physical reminders helps shape those habits. So role models, really being very visceral about your role models. And then the last was just this notion of stewardship, that, you are money man, all the terms that get used for what we do are ways to maybe make it more neutral. And I think Charlie's deep sense of stewardship and his inculcating that into me, that this is not a game. This is, you're entrusted with people's life savings. And that notion of stewardship, it really, coming out of that breakfast and then all of our meetings subsequently, that idea, it led to wanting to have a board of directors made up of people that I admire, because, as Charlie said, you want a board of people you admire so that you don't want to disappoint them and you would never imagine lying to them. They're the representatives of your clients. And so I mean, we could spend the whole rest of the time on Charlie, but the behavioral finance and inversion as sort of investment aspects, and then the importance of habits, role models, and stewardship as sort of ways to live your life, just hugely stood out. And there were ways that I could never be like Charlie. I mean, not just IQ, but also just his ability to really be indifferent to what other people thought. I don't have that. I admired it so much in Charlie. Charlie couldn't care less if people thought he was a curmudgeon, when, of course, in fact, he was one of the warmest and kindest and most loyal people I knew. But he didn't really care if people thought that. He was his own judge, and he was a tough grader. I probably pitched him for 4.5 minutes. He gave his answer in 30 seconds. But what was wonderful is, with that 5 minutes behind us, we sat there for another 3 hours, and that was the 3 hours that changed everything. But you're right, his distillation. I think Warren once said that Charlie had the best 30-second mind that he had ever met, where he could look at something very complex, see something that nobody else saw, and see that that was the fulcrum, that was the linchpin that on which everything would tilt. And I can think of so many examples of Charlie seeing something in a way that was totally different than anybody I knew saw it, and yet was so deeply and profoundly accurate.
The other thing you said that really has helped me in listening to other interviews you did in terms of reframing the way I think about things is this idea of stewardship. Because the business we're in does not have the greatest reputation with people. And, when you think about it from that lens, the way people think about it, it's not as positive as it should be. And when you flip it around and you say, we're stewards of people's capital, like, that's a really honorable business. I thought that was a really cool way to flip it and to look at it as what it actually is versus maybe the way the public perception of it is sometimes.
Yeah, well, it's, I owe a lot of that to Charlie, but I also owe a lot of that to Tom Gaynor. Tom, but it's not a coincidence that, I met Tom in Omaha probably in 1990 at the Orpheum Theater. And, Tom's the CEO of Markel Insurance. Back in those days, he was just a crank in their investment department. But we met just during one of the breaks at the Berkshire meeting all those years ago, whatever that is, 30 years ago or more. And yeah, Tom raised that notion of stewardship as a biblical profession as well. And Tom is a very faithful person. And having been in seminary myself way back, I was struck by that phraseology and this idea of it as a biblical profession, the idea that you're trusted with something. And it really did shape what we did. There's so many books about Wall Street, even my grandfather called it the best game in town. And that part of it, there is something enormously complex and challenging about it. It's like playing bridge. I mean, it's such a beautiful, elegant, intellectual pursuit. But for me, it really matters that you don't lose track of the fact that it's not a game. That it really is, it really is a question of whether somebody who's trusted you with their savings will be able to live independently. or whether they'll become dependent on somebody else. I mean, there's an enormous amount of dignity and responsibility in that. So, there's certain words that at our place we don't like, like one is story, oh, this is a growth story, or this is because it takes you away from the idea that this is a business. It's not a story. And once you think of it as a story, you start looking for facts that, well, you can hang on that story that advance the plot. And it makes you much more selective about what you see. Because you've got a story in mind. And of course, then you look for facts to fit the story. So we try to resist using that term to describe a business. And, but I think you're right. Things like game, this is a peculiar one, but even the difference between being in a business and a profession, right? We buy businesses, and the way you judge a good business is whether or not it makes a profit. A profession is a little different. We're in a profession, and in a profession, you don't sell a product to a customer. You provide a service to a client. You could say, well, it's just words, but they're important words because, as I say, in a business, you sell a product to a customer and you measure your success based on the profits that you make from that sale. In a business, in a profession, you're providing a service to a client, and the only way to measure whether you are doing a good job or not is in reference to the client outcome. So if you were to think like, who's a good doctor? Looking at their tax return is not the right answer, right? Measuring their profits as a doctor there may be some correlation or not, but what you really have to look at is patient outcomes. And if you want to look at a teacher, you have to look at student outcomes. You can't look at, oh, well, who's the highest paid teacher that's out there? So, very much in the way what we do as fiduciaries is we think based on what is the client outcome versus what are the size of assets under management? What's the profitability of the firm? What's the growth of the firm? We don't think any of those statistics will tell you whether or not you're doing a good job as a professional. So, those sort of nitpicky words to us end up mattering. And so that idea of stewardship is sort of baked in there. And as I say, that one is that was a double assist from both Charlie and from Tom.
I just wanted to ask you a couple of portfolio management questions before I hand it back to Justin. The first is, one of the things I've struggled probably the most in my career with is this idea that when I buy a stock and it's going up a lot, I want to get rid of it. It's like my value nature. And one of the things you've done a good job of with the Amazons of the world is you've been able to hold them as, at least on the outside, they've gotten more expensive. So I'm just wondering, how do you think about that process of a stock you own is doing really well, maybe the valuation's going up? How do you think about the process of when it might be time to sell it and when you want to hold it?
We haven't done a good job on that. I wish we had. It's by far the source of biggest loss, biggest mistakes in my career have all been the sort of the valuation sales. We own 17 million shares of Costco. We sold it when, we probably bought it at 14 times earnings. It got up to 18, 20 times earnings, and the earnings were up a lot. And we thought, well, that's pretty full. So we trimmed some because now it's a bigger position at a higher valuation. All the theory tells you to trim some. Then it went to 25 times earnings. We said, well, Jesus, if we were selling at 20 times earnings, now it's even bigger. We got to sell more. And we were completely out at about 27 times earnings. It's probably 30 times earnings now, but the earnings have gone up so much. And when Charlie was critiquing that decision of mine, and not using particularly kind language, he said, it was not only asinine to sell it and he said, the reason it was asinine is, one, you lacked imagination to see how it could play out, not over the next 5 or 10 years, but over the next 20 to 30 years. So your time horizon, you just couldn't imagine that the competitive advantage could be durable for that long. And those out years make such a huge difference, and you couldn't see that. And he said the second thing is, you're going to pay your damn taxes, And then you're going to get into some mediocre piece of crap. And you are failing to correctly assess the risk of doing something stupid with the money that you realize from this wonderful decision that you made. He said it was a decision where you beat me. Like, Berkshire should have bought that block, and you bought 17 million shares in one day at 27. The stock had closed at 40 the day before. We were ready, and we just jumped in there. And so we made a lot of money, but that's it. And as I said, in screwing up my Amazon calculation earlier, it was partly because, I bought my first Amazon in 2002 when Amazon, it was like at 6. And, I sold it at 19 with a quick triple in like a year and a bit. And, it was the same calculus. I couldn't imagine the advantage being so durable for so long. And like you, I just assumed, well, if it had tripled and now it's a bigger position, it must be a sale. Well, this tendency to cut the flowers and water the weeds is always a value investor's biggest risk and their biggest mistakes. And I can give a whole list of those. Now, there's some reasons that I will not give myself a hall pass, but I will say that there are a few mitigating factors. One is if I ran my own account separately from our clients, rather than just put my money in the funds, I would not be inclined to sell anything that had gone up a lot because, one, I wouldn't want to pay the taxes, and two, I wouldn't worry about having 30% or 40% of my assets in a single stock. And so, plus I have income coming in, so I could just continue to dollar cost average and, whatever. But in a fund, you think about that notion of, well, is there a risk of my having too much if a client has their life savings and it's $29,000 with me, can I afford to be quite so cavalier about the risk of a 50% loss in a 30% holding? And then of course there are some actual regulations around the 1940 Act that govern mutual funds and diversification rules and so on that we have to be mindful of. But I would say if you were to ask me my biggest mistakes, my biggest weaknesses, it has been exactly what you say. And I think we have done a better job. One of the reasons is I have a fabulous partner in Danton. And, Danton has been, he's everything you want in a partner in that I think we make each other better. I think I have enormous admiration for him. And when he first joined me all those years ago, my father had sort of a soft cap at around 5% of the fund. And Danton and I immediately moved that up to 8 to 10. And that really did help us in things like Amazon. So I would say that if you wanted a mechanism to deal with it, what I would say is to recognize that fair value is a very broad range. And if a company that you own is within that range of fair value, you don't need to take any action. All action should take place at the extremes of that. And I think that as a portfolio manager, you can sometimes try to narrow that range of fair value too tightly. And then, of course, you begin to anchor on where the stock used to be. So, growth managers have a shortcoming that when they own a stock at 60 and it goes to 30, they want to sell it. Value managers have a shortcoming when they own a stock at 30 and it goes to 60, they want to sell it. Both are stupid because where a stock was has nothing to do with its value, right? It doesn't matter that something was at 30 and now it's at 60, or something was at 120 and now it's at 60. Where it was before doesn't matter. What matters is what does 60 mean relative to the stream of cash it will produce between now and kingdom come. And so, the fifth thing in Warren's letter that money managers tend to underperform was inertia. And that idea of being imprisoned by your past decisions is one of the most important things all investors need to work, whether they're, in the growth category, the value, you bought it at some price, and because your past action is having an irrational influence on your current decision-making process, or you didn't buy it and it went up a lot. So now you don't even want to look at it. That was me and Apple for years. I couldn't even look at it. I was so upset that I hadn't owned it. So that's another example of inertia. So every investor can get, I would say that inertia, fixing the way that the past performance of a stock and your actions in response to that performance distort your current thinking. That is a very, very good thing to try to work on fixing. And I got a lot of room to fix that one. That is, so I love what you say. And it did help us own Amazon, but Meta is a more recent example. We bought a lot of Meta a year and a half ago. It was at 9 times earnings, excluding the metaverse investment, probably 14 times, including that. It was at its lower market cap than Home Depot with 2.5 billion customers, the number of customers growing and engagement still growing despite what everybody said about TikTok. So it was a hell of a great buy. But, the thing triples in a year and a half. And what are we doing? Oh, sell something. So, we trim, but we are trying to get better at that. But, again, it was one of those things. If it had been in my personal account, I probably would have just left it there and not looked at it. So anyway, that's overly, maybe, I don't think it's overly self-critical, but it's certainly self-critical. And I do think it's an area every single investor I know, and I'll give the exception. The exceptions are Warren, Bill Ruane, and Bill Miller. Those are the 3 investors I can think of that were absolutely comfortable having something run up to 20, 30, 40, 50% of their portfolio without worrying about it. And that takes enormous resolve. And that's still an area we need to work on. And as Danton said to me, it is an area we need to work on, but the tail end of a long bull market is probably not the right time to work on it. So you don't want to learn the wrong lesson at the wrong time. I mean, obviously, Apple, Meta, Amazon, Google, you were wrong to sell them at any point. But there's a lot of history where having a valuation discipline has served, especially when you recognize that you're in you're in a long marathon of a discipline. And so managing that risk and managing that concentration is important, and not always looking for that slugging percentage. But those investors I really admire. And of course, Charlie too also had an enormously concentrated portfolio when he ran money separately.
But like you mentioned, there's rules in the fund industry that make that, what Warren and Charlie do, those of us that run, public funds, it's much harder to do that. I noticed you definitely run a high conviction strategy. I mean, I looking at your US fund, I think you have 3 positions that are in the 10% range. So you definitely are, have high conviction in what you're doing. And my next question is around that same area. I want to ask you around sector concentration, because that's something else I struggle with a little bit is, when I have high conviction in a sector, how far do you go? And, one of the things I'd learned in looking at your fund is you have high conviction in financials right now. And I'm wondering, how do you think about that limit? Like, how do you think about how much you'll put of the fund in a specific sector like financials when you have high conviction that there's a lot of opportunity there?
Well, it's a great question. And you're right. I mean, relative to the average fund, we are concentrated, focused, disciplined, selective, all of that stuff. And, certainly our tracking error or whatever those ratios are show that we really don't look anything like an index. So in that sense, but to this question of sector concentration, I'm going to say something that may alarm, at first blush, might alarm the sort of consultants out there, which is, I really think that the sector concentrations as they're defined have nothing to do with risk or even anything to do with concentration. What really matters is the degree to which you are positioning the portfolio to be extremely vulnerable to a single exogenous or macroeconomic event. So what I mean by that is, if I had a portfolio that was 100% in financials in 2007, and you would say, holy cow, that is super concentrated and you're going to get killed. Now, if I had a portfolio that was in 3 different sectors, a 3-stock portfolio in 3 different sectors versus a 3-stock portfolio in financials, you would say, well, that's going to fare much better. But if the 3 stocks were, Countrywide, Toll Brothers Home Builders, and I don't know what, Lehman, you would say, well, you actually have an enormous exposure to a single macroeconomic variable, which is residential real estate pricing. Now, if my three that I owned were Bank of New York, Amex, and Berkshire, which bizarrely is classified as a financial, you would say, well, you were 100% in financials, but you were way more diversified, than you were in this portfolio that had a third in three different sectors, because you were tied in one case to very different macroeconomic variables than you were in the other. So we try to look through the portfolio and think about risk and concentration in those terms. So when you think of financials in particular, there are just so many vastly different models that fall into that classification, right? You think about, Chubb is in a wildly different business than Wells Fargo. And Wells Fargo is in a wildly different business than Bank of New York. And those are all in a different business than Julius Baer. So there are four financial stocks whose businesses are going to be significantly uncorrelated, even though their stocks might be correlated, right? The stocks will be correlated because people swing into the sector, or they swing out to the sector. So we pay little attention to stock correlations or sector categorizations, but we pay enormous attention to, are we making unintentionally concentrated bets on some sort of macroeconomic variable, residential real estate, interest rates, the currency, commodity prices, a recession, and so all of those, we try to think a lot about strange things that can happen in the world and change in the world, and then stress test the portfolio to say, are we overly indexed to something like that versus, okay, you have, a big chunk in financials, but the financials include Berkshire and Bank of New York and Wells Fargo and Julius Baer and the Development Bank of Singapore and Chubb, and, where you'd sort of say, well, that Markel, that's a very, that's a pretty diversified portfolio. I don't know if that helps. Obviously, it was influenced by the fact that my grandfather was 100% in financials. Well, I'll give you one piece of data, which is, I started our financial fund, I want to say 1989 or 90. It's been a long time. And it was coming out of the S&L crisis when I started it. And it was partly because I was joining this family firm, a firm controlled by my father. And I wanted to have my own record, because otherwise we were starting to look a lot like employer of last resort for people with the same last name. And so I felt like if I had my own record, and I was a bank financial, S&L and insurance analyst before. And so I said, I see this huge opportunity in this sector. And so I'd like to start a fund only in this sector. And what's interesting about that fund is the financial stock index has underperformed the S&P from then to today. And our financial fund outperformed both the S&P and the financial stock index. And yet it was 100% in financials. And so there's just such a broad range of business models and specificities in financial services. So I am a little bit of a broken record in that I've always liked financials. There's never been a period when I thought you shouldn't own any financials. But I've always been open-minded that within financials, there is a huge dispersion of business models and outcomes, management qualities, risk profiles, and so on.
I want to go back to something we were talking about a few minutes ago and try to weave this one together, because I think you're going to have an interesting perspective on it. So, have you ever seen the list of like the top companies in the S&P 500 by decade and how much they've changed over time?
Yeah.
And I'm sort of like, that really resonates with me. It's like the Joseph Schumpeter perennial gale of destruction and capitalism destroys. But I'm wondering, do you think with the largest, specifically thinking of these like big technology companies that dominate like the S&P right now, do you think there's a higher probability that these companies can stay more dominant longer given the structure of the firms? Or do you think that's not right? And 10 years from now, the top companies in the S&P are going to look very different than they do today?
Well, it's always hard with the top 10. I mean, I often think that, probably 10 through 50, there was more consistency. In other words, an interesting exercise would be to invert that and say, what are the characteristics of the companies that have excelled in all decades or for many decades? And so, obviously you'd have a company like Exxon would be at the top of that list. Philip Morris would be high on that list. Um, uh, you would end up probably over-indexing to companies that were in non-obsoletable businesses. And if you wanted to do it based on good performance of that business, it would probably over-index to companies where the number of shares outstanding didn't go up. And we've done that exercise over 50 years. And so I do think that there are characteristics of durability that get a little bit misrepresented by the creative destruction of the largest ones. Sometimes those are driven by geography or particular bubbles in a sector and so on. But if you were to say, what made Johnson & Johnson great for the last 30 or 40 years, what made, Coke great, what made, Colgate, Palmolive, some of the consumer companies. And I do think that a lot of those characteristics exist in some of the technology companies today. And I would call them sort of the blue chips of tomorrow. In other words, in the same way, basically the economy has dematerialized. If you look at how people spend their time, how they spend their money, what are the habits that they do, it's not, that's that long-term legacy that sort of said, oh, technology here today, gone tomorrow, stay away from tech. Obviously, the biggest example of somebody changing their mind on that was Warren, because you see, Apple was his biggest purchase in history. And that was a company that, he would not have owned in a different era, I don't think. I can't obviously speak for him. But so something changed in the nature of technology over the last 20 years. And the question is that likely to persist? Well, I would go and say something also changed in the nature of consumer companies in the 1950s that made them great for the next 50 years, which was basically you had national advertising. And before there was national advertising, every city, every region had its own consumer companies. If you were in one region, you had Knee High, in another region, you had Dr. Pepper, in another region, you had Pepsi, in another region, you had Coke, in another region, you had Budweiser, in another one, you had Stroh's, you had Old Milwaukee, you had, every city had its own beer, had its own media companies, had its own bank, had its own consumer companies, and its own department stores, for example. And so with national advertising, something changed dramatically. And you got the idea that you got winner take all brands. And the economies of scale that came from being able to advertise on television meant that Ivory soap just became dominant, and Coke became dominant, and Budweiser became dominant, and all the little regional beer companies, and there were, in financial services, it's related, but a little bit different. In retail, it's related, but a little bit different. But you got Walmart replacing the regional department stores and so on. I think the same is true in a way of technology, that you basically have had a shift where it is a bit of a winner-take-all business, where the scale advantages are self-reinforcing. And so I think, it's hard for me to imagine what displaces, Instagram, Facebook, Google, Amazon, AWS, Microsoft, Apple. It is a hard thing to play out a scenario where they're displaced in the next 20 years. And, I used to think Apple would be the easiest one to displace. Just because they're so dependent on this little box that is this is obviously not the technology of the future. We're going to look back and say, this is the craziest thing ever. We're all looking at this little screen. Of course, it's going to be a heads-up display of some kind, whether it's going to be these crazy goggles or whether it's going to be just eyeglasses. But this is a crazy medium. And in the same way, this displaced the PC, which displaced the mini, which displaced the mainframe. There will be another transformation. And that, in some ways, I've thought makes Apple vulnerable in a way that it's harder for me to imagine how you displace, what Amazon does, or in some ways the network effects of things like Instagram and Facebook. But they aren't bulletproof. But I do think that the analogies of what it meant for Procter & Gamble to sort of swell up and just dominate a section of consumer products, or what it meant for Coke to do that, or what it meant for Anheuser-Busch to do that in the consumer economy. I think the same thing has happened in the digital economy. These digital giants have established scale advantages where it's hard to imagine guys in a garage trying to figure out how to displace that.
We probably could spend another 2 hours with you here, and maybe we can get back on again in the future, because this has been awesome and excellent. I knew it would be. I mean, you bring a super thoughtful perspective and all this stuff, historical, long-term view of things, which, I know really resonates with our audience, and it's what works in investing over time. So I really appreciate, this knowledge and wisdom that you're sharing. And we do have one sort of standard closing question that we'd like to ask all of our guests. I know yours is going to be great, which is, if you could teach one lesson to your average investor based on your wisdom in the markets, what would that be?
Well, it would be that you own a business. You own a business. And this idea that you own a trading sardine instead of a business leads to so much bad behavior. And really, you guys raised it the best. When Jack was talking about selling those winners, if you just think of that I own this wonderful portfolio of businesses and I want to pass them on to my kids or my grandkids, I think it keeps you out of owning stuff because you think it has a quick double, and it keeps you out of selling stuff simply because it doubled. And I think that everybody would do better, if they could think. And I had my first girlfriend was from Maine, and her father worked at Bath Iron Works, and he showed me his portfolio. And it was such a wonderful portfolio. It was about 8 stocks that he had bought over the years, very thoughtfully and carefully. And it had just built into this real source of wealth. And I would guess that he had outperformed the market. But even if he had just simply tracked the market over this long period of time, but he did it with deep conviction because he saw each holding as a business. He didn't see it as a stock market. He didn't see it as a piece of paper. And I think that, really thinking about that and thinking about what it is to be an owner of a business, I think that would really improve a lot of people's returns over a long period of time.
Excellent. Thank you very much, Chris. We really appreciate it.
Oh, I love it. You guys, I could have done this all day, so the time got away from me, and I'm sorry if I was long-winded and we missed topics. I can't tell you how much I enjoyed it. Thank you so much.
Thank you.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant, and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at VALIDEA Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of VALIDEA Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of VALIDEA Capital.